The LLC is very strong when it comes to protecting you personally, your personal assets from somebody that's trying to get to you because of the fact that you are, doing business with them. But now, as I mentioned earlier, the downside of the limited partnership is it doesn't give us any special tax benefits. Any income that we generate through our LLC is going to be subject to our self-employment tax, our Social Security and our Medicare tax, and our income tax. So that money that comes to us is double taxed. So if we do nothing, we're going to have great liability protection, but we're going to have problems when it comes time to pay our taxes.
Hey, what's going on, everybody? Joel Irway here, and welcome to another very special episode of Experts Unleashed. And guys and gals, I am super excited about this interview here today because we're going to talk about legal stuff. Now, I know it's not really exciting for most entrepreneurs, and I promise you, it took me a while to get excited about this as well, but the light bulb moment finally clicked. So I had a conversation with our guest here, Ross Brunson, a few weeks ago, and Ross and I were talking about his bulletproof business structure. We were having a conversation. He was explaining why it's so important for entrepreneurs to really take their business structuring system seriously, and why 99% of entrepreneurs do not do it the right way, and they're doing it the wrong way. And it, number one, leaves themselves exposed to all sorts of potential legal issues. That exposes their assets in case they get into, a lawsuit or any sort of behavior or any sort of risk potential. And number two, when they do it wrong, they're actually paying more in taxes. So we had a great conversation. The light bulb moment finally clicked for me after a while. It took me a while. I'm a slow learner, and legal stuff never really gets me super excited. But I promise you, the reason why I have Ross on here today is because this is really important. And so, Ross, I'm excited to have you, man. We are going to be diving into your business structuring system. Welcome to the show.
Thank you very much. I appreciate that.
Ross, why don't you take a couple seconds, 30 to 60 seconds, give our listeners just a quick background about, who you are, what's your history in setting up entities and in setting up this business structuring system. Give our listeners a 30 to 60 second background about yourself.
Okay, sure. My name is Ross Brunson, and I have a nice family. I have a wife, a sweet wife I've been married to for almost 50 years. I have 5 beautiful children, 15 grandchildren, and I've been involved in this type of work since 1990. I started an accounting business that did accounting for people, and also I was doing tax returns for people. And during that time, I had many people come to me and ask me if I would help them set up their business and then perform the services of doing the accounting and the tax returns. So at that point in time, in the early 90s, I started doing that with people. I would get involved with getting their business set up, whether it be a corporation or an LLC, whatever it is that they thought that they needed. I would help get it set up, and then I would help them with their accounting and their tax returns at the end of the year. But over that period of time, I got to know a lot about businesses and business structuring. And I understood and helped my clients understand that every business entity might have a strong point, which is really good and something you should want to take advantage of, but everyone had a weak point. And so that's kind of what led me into what I'm doing today with my current clients.
Got it. And so I think this was, I think this is a really important point to highlight, meaning, you got into, after working with entrepreneurs and working with all sorts of clients and helping them set up their businesses. Where did you see this opportunity that you've now discovered with your business structuring system? You talk about how, the different types of businesses, some have weak points, some have strong points, but for the general entrepreneur, a lot of us, when we're first starting our business, we really don't, myself included, we really don't know what we don't know. And so can you explain, what most entrepreneurs consider when they first start up their business and why that can be a recipe for disaster as they grow.
Sure. What I find is most entrepreneurs, new business owners, they want to start out in business and they're all excited, and they should be because it's a great opportunity. But they have never had any training at all in their life as to the right type of business structure, entity, I might say, to use. So what I find is they start asking around. They ask their friends, "Well, what should I be?" When I set up my company, and sometimes they'll get an answer. You should be an LLC, and they go, "Well, okay, that's great." But if they were to then ask that person, "Why should I be an LLC?" the person probably would have said, "Well, I have no idea. That's just what someone told me." Or the same thing, they might have someone that'll say, "You ought to be an S corporation." And if they knew enough to ask, well, why should I be an S corporation? Again, the people are going to say, well, I don't know. This is what I heard, or my CPA told me this, so they're asking people that have no expertise, that don't understand the strengths of the entity that they're recommending or the weaknesses. So if a person were to just take their friend's recommendation and set up a company, they might find that type of company will give them some tax benefits, but maybe not very good when it comes to protecting them from liability issues. Or the opposite may be true. Maybe it'll give them decent liability protection, but will provide no tax benefits. So, and of course, as you say, you don't know what you don't know, as you were mentioning in the introduction. These people don't know what they don't know. They just think, well, okay, if someone's telling them about it that has some sort of an understanding, they will tell them what the strong point is. This one's going to give you great tax benefits, or this one's going to give you great liability protection. But they don't ever say, oh, but there's a downside to it that you probably need to be aware of, before you jump in and commit yourself to this type of an entity.
Yeah. It was funny when we were talking the first time. Anytime we start talking about entities, legal, accounting, I get really sleepy, right? It's like I just start to, it just goes over my head, and it's just like, okay. I talked to my accountant, whatever, 5 years ago, 6 years ago, when we got set up, so I just trust them, right? And I
Right.
think this is where it was really an eye-opening conversation for me. It's that my situation changed. Where I was 6 years ago was not where I am today. The business is completely different. Our revenues are completely different. Our profits are completely different. I've got a family now. I've got 2 kids. So your situation changes. And I think this is where, I think it was a good place for me to reconsider all this. And you started to open up my eyes with like, okay, it's not just pick the one right entity for you, right? You have a unique method. It's actually multiple entities, right? It's the
Right.
way that you acquire, that you protect yourself and reduce your amount reduce your tax liability is by not choosing just one, the right single entity. It's actually layering and doing 2 or maybe 3 entities within your business structure. Is that correct?
Yes. Let me see if I can explain it to you so that it's easy to understand. As human beings, we don't like to be too hot in our lives. We don't like to be too cold in our lives. We don't like to, have bugs attacking us. We don't necessarily like to sleep in the dirt every night or cook our dinner in the dirt. And so what do is we build a structure around us to protect ourselves. So we build a house. So we have this house built, and we move inside. And if we get too hot, we can turn on our air conditioner. If we get too cold, we can turn on our heater. We can protect ourselves from all the elements outside by living in this house. But as we construct this house, we start thinking about different rooms. You might say, well, in my house, I need to have a kitchen because I want to be able to cook dinner. Or I may need to have a bedroom because I may want to go to sleep. Or I might have a living room because I may want a place to sit down and relax or entertain guests. So when you think about these rooms, we put these rooms into our house. each one of these rooms has a really strong point. For example, if you're going to cook your dinner, the kitchen is the best place to go. But the kitchen is not a great place to try to sleep at night. Or you may want to have a bedroom in your house. And bedrooms are great if you want to go to sleep, but you're not going to want to entertain guests there, or you're not going to want to cook your dinner there. So as you look at each one of these rooms, each one has a strong point associated with it, and each one has a weak point associated with it. But because we bring them all in under the same roof, we can take advantage of each of the strong points. So when I want to cook, I can go to my kitchen. I don't have to sleep there. I don't have to entertain my guests there. If I want to sleep, I can go to my bedroom. I don't have to cook my dinner there. So by being able to take advantage of each of the strong points in each of these rooms, we're able to eliminate all the negative points associated with those rooms as well. And as a result, we get the best of all worlds because we are specializing. Our rooms are specialized for certain specific things. And when we help people set up their entities, we look for the same thing. We want to build a structure over their entire business. We don't want to just say, here's an entity, take this entity, because as we mentioned, there's going to be a strong point to it, but there's also going to be a weak point associated with it. So what we want to do is we want to say, look, we have entities that can help you reduce your self-employment tax. And we have entities that can help you reduce your income tax. And we have entities that can protect your personal assets from something you might do in your personal life. Like, have you had a serious automobile accident and you get a judgment against you for more than your policy limits, and that puts your home, your savings accounts, your money market, brokerage accounts, those types of things are all at risk. Well, we have rooms that can protect that. We have rooms that if, you have your business, will hold your business in that room. And if something happened within that room in that business, it's not going to be able to spread through the house to you and take your personal assets. So by combining several entities together, again, we can take advantage of all the strong points of each one, and we can eliminate each of the weak points of each of those entities.
That was what made it click for me, right? It was not relying on one single entity, but taking strong points of multiple entities and combining them under one structure. Can you walk us through, or maybe give us an example of, say, when somebody should consider, because the vast majority, I'm just going to make a broad statement, and you would know better than I would. I would say the vast majority of us are probably under just a single entity, right? At
Right.
what point should we consider, like, what point should our business be at where we consider, all right, hey, it's really worth talking to somebody like you, Ross, about building a business structure and combining multiple entities for tax reduction and asset protection? At what point should we consider that in our entrepreneurial career?
Well, if you think about it, when you first start your business, when are you most likely to make a mistake and get yourself sued? Right off the bat. So
Yeah.
why would we want to postpone that for some later time when we're maybe more experienced? So for liability, it would make sense right away that you start looking at an issue. But then as you start earning taxes or earning income and having to pay taxes, it doesn't take much income before your taxes start to rise. One of the taxes we face is our Social Security Medicare tax. They call it self-employment tax. Well, it's 15.3% on every dollar of profit that you make. So if you take whatever profit amount that you make and you times it by 15.3%, whatever that figure is, it doesn't take long before that tax obligation that you're going to suffer is going to be greater than what it would cost for you to create a structure to protect yourself from that. So I would recommend most people need to start thinking about this right off the bat. Get yourself set up correctly at the beginning. Make sure that you're not going to have a liability issue, especially when you're most vulnerable, when you least know what you're doing. Protect yourself from that. And then also, if you make any type of income, $5,000 to $6,000 of income, $10,000 of income, there are taxes you could save by having your structure set up even at that low level of income.
Where are most where are most people like making the mistake in their structures? Like when we first start to make that consideration of like, okay, I've got a single entity system right now, and I want to consider going into a two or three entity, business structure. What's going through their mind? What is top priority when they come to work with you? Is it primarily tax reduction, or are they coming to you when they're in hot water, they've made a mistake, and they want to make sure that they're protected? I'm assuming if it's the latter, then it's usually too late. If they've already made a mistake and they're in hot water, it's probably too little, too late. But what's the general, like, when do most people come and reach out to you?
Well, most people don't believe that they're going to be sued, which is sad because in America, there's a new lawsuit filed every 2 seconds of every day of the year.
Oh,
And
jeez.
I even heard, some of you may know Bill O'Reilly. I listened to one of his presentations, and he made a comment that over 50% of all small business owners were sued last year, over 50% in 1 year. So, yeah, that's a problem, but most people don't think about that problem. What they're thinking about is, oh man, I got to pay taxes. And my business is starting to grow. I'm starting to make more money. And all of a sudden they get a tax bill of, 20,000, 30,000, 40,000. They're like, whoa, I can't do this. That's all my profits that you're taking, that the government's taken from me. And so it's usually at that point where they're just so concerned and they're so nervous and they're seeing that their tax liability is going to be so high that they finally come and want to talk about it. And so that's when most of them come to us, when their taxes are getting high. But we try to help them understand that liability is also a very important part of your overall structure. But I would say it's taxes that seem to, give them the idea that they better talk to somebody.
Do you find that most people are set up as an LLC or an S corp? Are those the two most popular single entity structures when they come to work with you, LLC and S corp?
Yes, those are the two. And when we look at those two, again, what are their strong points? The LLC strong point is it gives you great liability protection. What is the strong point of the S Corp? It gives you some good tax saving features, specifically against your self employment tax. So, those people that talk with their CPA will usually be guided towards the S corporation because the CPA knows that, hey, my job is to save you taxes. And I'm going to look like a hero because I'm putting you in an entity that will give you tax savings. However, that entity probably doesn't have very good liability protection when all things are considered. So, but that's not a concern to the CPA. But if someone were to talk to an attorney, especially that specializes in liability, and ask them, what is the best entity for me to set up? Well, that attorney is going to be concerned about protecting them from liability. So the attorney will always tell them you need to be an LLC. But that attorney also doesn't understand the fact that by telling them to be the LLC, the weak point is that this person's now going to be paying more in taxes. So, you know, when they come, they're kind of split between these, but a lot of it has come from them speaking with somebody that has a specific reason for, telling them or giving them, suggesting to them what they should, how they should set up their business.
So how did you kind of discover the fact that you could build structures, build this corporate structure, build these business structures and combine these entities? Was it by sheer dumb luck? Was it out of necessity? Like, how did you discover this business structure system that now you advise and you help people set up to combine the best of both worlds?
Well, it was interesting. That's a good question. um, as I was running my little business, helping people set up their businesses and helping them do their accounting and helping them do their tax returns at the end of the year, my business was growing and I started making a lot more money. So I was falling into the same category of a lot of these people. And so I started looking for a way that I could reduce my taxes. And I ran across a person who claimed to be a tax attorney, though I later found out that that probably wasn't a true statement. But anyway, he was telling me about a business entity type, what they call a business trust, and how this business trust was going to be able to save me in taxes. So I started listening to him, and in essence, what he was saying is that a business trust has two different ways that the trust can be, that the owners of the trust can be paid. They can be paid for the work that they do in this business trust, running this business, and any money that comes to them in that way would be considered active income, subject to our self-employment tax and our income tax. But he says that also you can distribute funds out of the out of the trust, business trust, to you and he used a position sort of like a shareholder in a corporation. You would be able to receive distributions, and by doing that, those distributions would come to you, and they would not be subject to self-employment tax. They would only be subject to income tax. So by splitting your money between active and passive, you could reduce your self-employment tax. So I thought, this is really great. So I paid him a lot of money for helping me to set up this business trust. And right off the bat, the very first year, I got audited by the IRS. And I found out at that time that I had not heard much of a business trust before in the work that I was doing, but it found out that there was a lot of these people who were, that they were kind of radical a little bit, and they were trying to tell people you can avoid paying your taxes by setting up a business trust, and and we'll set them up for free for you. And so they were making a lot of waves, a lot of noise, and the IRS was watching it very carefully, and they decided, well, we're going to stop this. Even though maybe this is true, we don't want them to think that they're going to be able to avoid all taxes by setting up this type of entity. So they started auditing every single business trust that was set up that in the year that it was set up. And I was happened to just be one of them. So they came to me and they said, sorry, we don't believe that you're a business trust. We believe that you're just a sole proprietor. And if you want to prove them wrong, I'd have to go to tax court. And so I said, well, I don't want to pay out money to go to tax court. So they recalculated my taxes as a sole proprietorship, which basically meant I had to pay the self-employment tax that I thought I was going to be able to save by going through the trust. So that didn't turn out to be a great experience for me, but it did give me an idea. It made me understand that, hey, maybe there are other entities that can provide this same tax saving feature. Maybe the IRS doesn't like the business trust, but is there another one? And then I discovered, well, the S corporation does the exact same thing that the business trust did, exactly the same thing. But if you were an S corporation, the IRS doesn't care. They're not going to come audit you. But because of the fact that they were, concerned about what was being preached about these business trusts, that was, why they wanted to audit people. So that opened my eyes. There are other entities that can do what I want to do without invoking the ire of the IRS. So I started a deep study of all the different entity types that are available to find out what benefits can they provide. Can they provide other types of tax benefits besides just self-employment tax savings? Can they give us income tax savings? And then I started wondering about, well, liability is a big factor. Like they say, a lawsuit filed every 2 seconds in our country. That's day and night, holidays included. I started realizing, as a business owner, I could be at risk if somebody decided they wanted to sue me. So again, that's what I was searching for. What entities give me the best liability protection? And that's when I discovered that every entity will have a strength and every entity will have a weakness, but there was never one perfect entity that I could take that would give me everything I was looking for.
So the IRS audited you because you were forming a business trust. Did I understand that?
That's correct. Yes.
So what about business trusts sends that up the flagpole? What about that flags that to the IRS?
It was just the people that were promoting it. It was what, the
Oh, so
IRS.
it was being associated with them. That's what flagged it.
Right. Right. That's the only reason, is that these people are claiming that you can avoid all taxes, not just income tax. And these promoters, of course, had no understanding of what that business trust actually did or how it did it. They just got word that it could save some taxes, so they just started screaming that from the rooftops. You can not have to pay a single cent in taxes if you run your business as a business trust.
Got
And
it.
of course, that wasn't going to fly, with the IRS.
Got it. Okay, so it matters. What you're saying is it matters almost equally as much who you associate with as it does the type of entities that that you end up setting yourself up with. Is that correct?
That's right. That's right.
That's probably something that most people don't realize is that you can get flagged by the IRS just by working with the wrong people, right?
Right. Exactly right. You sure can.
Jeez. Kind of makes me like incredibly fearful of just like stepping on the wrong toes or like thinking that you're doing the right thing, thinking that you have all the best intentions in the world, like, hey, this person says, okay, let's set up this structure or whatever. Nope, that's going to trigger an IRS audit. Like, huh.
Right.
But anyway, but that obviously working with you doesn't trigger an audit, and it's like because those people were doing unethical means of promotions and obviously not being truthful, the IRS knew that, and that's what flagged it. But it's still, you don't want to mess with the government. You don't want to mess
No,
with the powers that be.
no. And it was not my intention to defraud the IRS either. It was just that he was saying that this is a function of this entity, which will allow you to be able to reduce your taxes. And that's all I wanted to do, is take advantage. If there's a function within an entity that allows me to reduce my taxes, why not take advantage of that function there? And so that was my thought behind it. It wasn't like, oh, great, I'm going to avoid paying taxes ever again. That was not my concern. But anyway, even though that wasn't my concern, I still was audited, and they helped me understand right away that they're in control, and that, we have to play by their rules, however they write them.
Those pesky IRS agents, nobody likes them. Hope you're not listening, to IRS. I'm just kidding. Well, Russ, let's walk me through an example of, let's say, a two entity structure, right? Where we want that protection and we want the tax saving benefits of say an S corp, but the protection of an LLC. So it's still puzzling to me, like how these two would coincide under one business structure. But can you walk us through how one of these things look, how it operates, who pays who, where does the money come in? Because if you're operating with two entities, like maybe we can just walk through step by step so people can start to see a clear picture of how one of these structures would operate.
The first thing that I think is most important is that we have liability protection. And the LLC provides us the best liability protection.
Okay.
Now, when we say liability protection, a lot of people might think, well, I'm setting up this LLC to protect my business and to protect my business assets. But that's not a correct assumption. An LLC can be sued, and they can win, and they can take the assets of the business. What are you protecting when you set up this LLC, encapsulating your business? Is you're protecting yourself from your personal assets. things like your savings account, your money market account, your brokerage accounts, your jewelry, your gold and silver, your house, your nice cars, all these things you're protecting by setting up this LLC. And if someone's trying to sue you because something went wrong in your business relationship, they can't go through that LLC to you personally and take these assets from you. So that's the purpose of all entities when it comes to liability protection, is to keep people from going through your business to you personally and taking your assets. So
Right.
that's why the LLC is very strong when it comes to protecting you personally, your personal assets, from somebody that's trying to get to you because of the fact that you are, doing business with them. But now, as I mentioned earlier, the downside of the limited partnership is it doesn't give us any special tax benefits. Any income that we generate through our LLC is going to be subject to our self-employment tax, our Social Security and our Medicare tax, and our income tax. So that money that comes to us is double taxed. So if we do nothing, we're going to have great liability protection, but we're going to have problems when it comes time to pay our taxes. So what we like to do then is set up another entity that can give us this protection as far as our taxes are concerned. And that second entity that we deal with quite a bit is an entity called the limited partnership. Now, the limited partnership is very similar to the S corporation in that it can give us great tax protection specifically for our self-employment tax. So if we create two entities, then our LLC as an entity, and we create a limited partnership as the second entity, and if we can combine those two, we're going to get the liability protection we wanted, and we're going to be able to match the same tax saving features that the S corporation was going to give us.
Okay.
So we want to do that. Now, one of the things that, one of the ways that we would do that in connecting these two is we would have the LLC be a single member LLC owned by the limited partnership. So now the LLC would provide the face to the business. So all income that is generated from the sale of the products or services provided would come into that LLC, and all expenses associated with that business would be paid for out of the LLC. But what's left over then is the profits. Now, the profits will flow to the owner. And in most cases, if you were an LLC and you were a single member LLC and, the owner of it, those profits would just flow to you and you put them in your bank account. But in this situation, in this structure, you would not be the owner of that LLC. Again, giving you some better liability protection because they can't sue you and take something you don't own personally. So you don't own the LLC anymore. You're the manager of it. You have complete control of it, but you don't own it. So again, now we're protecting ourselves from this side, the side where people are suing us personally. So we're getting the business protection and we're also getting the personal protection, that lawsuit scenario where they get a judgment greater than your policy limits and they're suing you for your assets. That business is no longer one of your assets because it doesn't belong to you any longer. It belongs to this limited partnership. So the profits then flow to the owner. So they flows to the limited partnership. Well, those profits had normally come to you subject to self-employment tax and income tax. But by going to the limited partnership, it is designed so that you can separate your income and take some of it as active income and some of it as passive income. So you're able to reduce your self-employment tax on all that income that comes to you that is considered passive income. So by doing this, we can reduce our self-employment tax at least in half. And some people like to do it even at a little higher percentage. So we have great tax saving features now by having these two together. But that limited partnership now gives us a whole new area of protection that we didn't have before. We mentioned that we have our personal assets, our savings accounts and brokerage accounts and things that are out there. And anything time we do something in our personal life, those things can be taken from us. Well, when we set up an entity, what we're doing is we're creating in the eyes of our laws a person. And I know that sounds really strange to a lot of people. How can a stack of paper be a person? Well, it can because of the way our laws are written and the definitions we have in our laws. If you were to look up the definition of a person in our U.S. statutes or even in the IRS code, they're going to say a person is a corporation. A person is a limited liability company. A person is an LLC. A person is a trust. All these different entity types are all considered people in the eyes of the law. But there's an interesting twist to it. Even though the laws are specific, that even though you created this artificial person, and even though you control this artificial person 100%, and even if if that artificial person held title to assets, and those assets generated income, and that income was distributed to you, even though all those things are true, that person that you created is not considered to be you. So that gives us a way to protect ourselves. So let's say you set up your limited partnership, which is now the owner of your LLC. And so it would have to have a bank account. And let's say at the same time you set up the bank account, you said, well, I'm going to set up a savings account also in the name of my limited partnership. And once you did that, you then transferred the money from your personal savings account into the savings account of the limited partnership. Well, now that savings account legally does not belong to you. So legally, you don't have a savings account. Your limited partnership does, but you control that limited partnership. You control that savings account. And if it earns interest, it can be distributed to you, but it's not owned by you. And if you had a brokerage account, you could go to your broker and say, I want to change the title of my brokerage account out of my name into the name of my limited partnership. And I want to use my limited partnership's EIN number, for tax reporting purposes. They will do that for you. They will transfer that into the name of your limited partnership. So now legally, you no longer own that. You control it. If it earns money, it belongs to you. I mean, you could distribute it to yourself, but you don't own it. So we come back to that scenario where you have this accident and you have a judgment greater than your policy limits, and they're coming after you, looking for you personally. After they've got that judgment against you, the courts will bring you into what they call a supplemental proceedings hearings, where the other attorney's going to be able to ask you, what assets do you own? Because they want to be able to grab them all. And so they're going to say, do you have a savings account? And you're going to say, I don't have a savings account. Do you have a brokerage account? No, I don't have a brokerage account. And you're answering truthfully because those things do not belong to you. Legally, they do not belong to you. They belong to this other person. And this other person was innocent. That other person wasn't driving that car into this other, into the injured party. So the courts cannot go through you, or will not allow that plaintiff to go through you, guilty in that accident, to an innocent person and take that person's assets from them. So we have a very safe place where we can now start moving our personal assets into that will give us protection for things we do on our personal side. And it's also great because the LLC laws basically state that, if somebody's injured through the business, they can come to the front door of that LLC and try to sue it and take its assets, but it can't go through to the owner, who happens to be the limited partnership, and take that person's assets. So we're protected from both sides because of the fact we have this limited partnership in play owning our LLC, which also gives us a tax benefit. So by combining these two together, we got substantially better liability protection, and we're getting the tax saving features of the S corporation.
So let me try and regurgitate that in a way that I believe I understand it. And you can tell me if I'm right, if I'm wrong. Say, Joel, you haven't been paying attention. You haven't been listening. Okay. Two-entity structure, a two-entity business structure. At the top level, is your limited partnership. This is kind of the umbrella. That
Right.
limited partnership owns an LLC.
Right.
LLC is what is customer facing. This is what the customers are going to use to transact with whatever products or services that you're selling.
Correct.
Am I with you so far?
Yep. Perfect.
Okay. So that LLC then, the only exposure that that business has is whatever is owned in the LLC, in the LLC bucket. Any assets that are directly owned by the LLC, not the limited partnership, just with the LLC. So if there's a business bank account associated with that, that would be associated with the LLC. That would be, I'll throw it in air quotes, at risk or a liability. Is that correct?
That's correct.
Okay. And so now, whenever I am looking to take a distribution or a paycheck, I cut a check or profits from the LLC and distribute it back up to my limited partnership. Is that correct? That's where I'm now collecting my income.
That's correct. It's the owner of the LLC, and so it's entitled to the profits as the.
That's right. The limited partnership is the owner of the LLC, and so it's going to take the profits. Correct. Okay.
That's correct.
Where is the connection with like me as a taxpayer to the limited partnership? So the limited partnership owns the LLC. Me, Joel Irway, where am I now associated with the limited partnership as the owner of the limited partnership? So I'm standing above the limited partnership. Is that correct?
Right. In a limited partnership, there's two positions: a general partner and a limited partner. The general partner runs the affairs of the company, makes all the decisions. The limited partner makes no decisions, has no management authority whatsoever. The limited partner or partners, all that they could do is invest money into the company, and the general partner then controls that money. So any money that is dispersed out to the general partner would be considered active income. Just like money that would be coming out of the LLC, it's going to be subject to self-employment tax and income tax. But any money that's distributed to the limited partners, because that money is coming to them based upon the fact that it's their money working in the company and not them physically working in the company, that money flows to them. That type of income is classified as passive income in our laws. And so passive income is only subject to income tax, not self-employment tax. So that those profits flow into the limited partnership. Then you, as a general partner, and by the way, you can be a general partner and a limited partner in the same company. Just like in an S corporation, you could be the president and the board of directors, and you can be a shareholder in your company.
Got it.
Well, the same thing is true in the limited partnership. So you could be in both positions. So let's say that you had $100,000 worth of profit. The tax on that would be $15,300. You say, I'm going to take half of that, $100,000. I'm going to take $50,000 as the general partner for the work that I'm doing, and I'm going to take the other $50,000 as a distribution to myself because I'm a limited partner and I've invested money into this company. Well, you just eliminate 15.3% tax on $50,000. That's about $7,500 in tax savings, just because you could split your income between active and passive because of a mechanism built within that structure that allows you to do that. So yeah, you're able to do that. And so that money, though, is controlled by you as a general partner. And if you need that money to live on, then you just make a distribution from the limited partnership to yourself and put it into your bank account and spend it for your general needs. But the nice thing is, let's say you put that $100,000 into the limited partnership, but maybe you only needed $50,000 during the course of the year to live on. Well, that other $50,000 you could have put in your savings account held within that limited partnership, a safe place, as opposed to putting it in a savings account held in your name, a very risky place. And so you could put it in your savings account, or you could invest it in your brokerage account, or you could, perhaps invest in other business opportunities. Maybe you wanted to get into rental real estate. And so, you would set up maybe a new LLC to hold the title to your rental real estate, have it also owned by your limited partnership. The limited partnership transfers money into your LLC. It buys the rental property. The rents come into the LLC. The profits flow to the limited partnership again, where they are accumulated and built and allowed to grow, so that if you down the road have any other business opportunities you want to invest in, you've got, basically you've got your family bank here that you are building your money in. And it also then becomes the investment arm of your business. It then is there to make investments, future investments in anything you want to invest in. And if you don't invest it, it's building up there. When you get to retirement years, you use it to help subsidize your retirement. So it gives you that opportunity to have a safe place to create vehicles to allow your money to grow. And when it's sitting in there, like I say, there's not a risk of you losing it by either a lawsuit against you personally or a lawsuit against your business.
So from a tax saving standpoint, where you are able to reduce your taxes is because of the definition of passive passive income, active income, which is separated between general partner and limited partner. General partner is going to be active income. Limited partner will be the passive income. And the passive income is taxed at a lesser rate than active income, correct?
That's correct.
Okay. Ross, I think I'm getting it. I think I kind of understand the general theme. I want to now move forward and just briefly talk about, that's a two-entity structure, right? Limited partnership and LLC. Separating the two, we've covered that. Let's take it one step further, because you talked about, on our first conversation, a three-entity structure. Now, we don't have to go into all the nuances, because I think we kind of understand general frameworks and general flows when we have multiple structures. That was my main goal with that, with what we just covered. But let's just talk at a very, very high level. Now, when would we add a third entity, and what would be the flow path of how those three would communicate and interact with each other? I'm assuming there's one entity that's still going to be customer facing, right?
Right.
And then where do the other two come in?
Okay, so the one tax that we have not yet addressed is the income tax.
Okay.
We've talked about the self-employment tax, our Social Security Medicare tax. So the limited partnership is very good in helping us reduce that tax, but it has no effect on your income tax. So whatever the income tax is going to be, you'd be stuck paying that unless you were to look for another entity, or basically another room in your structure that will provide the benefit of saving you when it comes to income tax. Now, the company that we like to use to do that is the C Corporation. And you might say, well, why the C Corporation? Well, many years ago when our country was founded, everyone was a farmer. They worked on their farms, and that's how they supported themselves. Well, over time, they realized that that's not a very safe way to live. You could have droughts that kill your crops, or you could have hail damages, or bugs eat them up, or who knows what. And so every year they're battling with all the elements, trying to raise enough crop to be able to have money to live through the next year. And sometimes they couldn't do it. They couldn't get enough money to sustain them, or enough produce to sustain them through the next year. So they were always, living in a very perilous position. Then our country went into the industrial age, and what they started doing is they started building factories in the cities, and they needed workers. So they would go to the farms and say, look, come on into the city. We'll hire you. You'll work every day from 9 to 5 or whatever hours they set. At the end of every week or every 2 weeks, we're going to pay you a paycheck. It's going to come every single week. And, you're not going to have to worry that you're not going to have money to feed your family. And so the farmers thought this is a fantastic idea. So they all came racing out of the fields into the factories, and they started working. And they found that that leveled out their concerns about not being able to support their families. But after a while, they started seeing that these factories were making a lot of money, and that they weren't sharing in all those profits. So they started going on strike to be able to force the owners to pay them more money. And that worked for for a period of time. But after a while, they started saying, we need retirement benefits, we need health insurance, we need disability insurance. There's a lot of things that we need that in addition to the money that we're making while we're working here. So they started striking for these types of benefits. Well, at the time, those benefits weren't something that could be written off against the income of the factory. So they had to go to Congress and ask them to pass laws that would allow them to deduct these types of benefits as expenses to the company. And so the government said that, we understand, and they did that. They set up those laws so that a business owner can offer some sort of employee benefit to the employee, and it could be a write-off to the company, and it would also not be considered income to that employee. So, and so at that time when those laws were passed, the C corporation was one of the only entity types that were being utilized. So all those benefits went to the C corporation. So it can provide the largest amount and the highest levels of employee-related benefits to the employee. Well, as we mentioned, employee-related benefits are a direct write-off against the income of the business. So what is it doing? It's reducing the income tax that business owner was going to be subject to. And so they're going to be able to provide this benefit, reduce their taxable income. The employee is going to be able to receive that benefit and not have to pay a tax on it. So we can bring this concept, this third entity, this third room into our structure, and we can put it to work. The way we would normally do that is we would then make the C corporation the manager of the LLC. So LLC can be managed by a manager or by a member. And so we want it to be managed by a manager, and this C corporation company will set up to provide management services as a service that it's going to market. And so it's going to market those management services to your LLC. And who's going to be the person providing those management services? Well, you will be, because you will be the employee of your C corporation. And as the employee, you can receive employee-related benefits. Your C corporation can provide retirement benefits for you. It can provide health insurance benefits for you. They can pay 100% of all medical expenses on your behalf. It can provide disability coverages for you. It has a whole large number of different options that are available, to the employees. So as that money flows out of the LLC, going to the C corporation, and the reason it flows is because the C corporation is providing a service to the LLC, which is an expense to the LLC. So as a business expense, the LLC pays the C corporation. The C corporation has hired you, so the C corporation provides you a payroll check and provides you all of these benefits, all of which are write-offs against that income that the C corporation has received. So by bringing this into the mix, we're able now to be able to reduce to a large extent the income tax you're paying based upon the amount and the number of employee-related benefits you want to provide to yourself. So it all comes together nicely under this one structure. We have the one entity, the limited partnership, that can reduce your self-employment tax. We have the C corporation that can reduce your income tax. And we have the limited partnership and the LLC that provides you liability protection for both business-related lawsuits and personal-related lawsuits. So by combining them all under one roof, just like in a house, we can get the benefits of everyone and not have to deal with the weaknesses of any of them.
Is there a general rule of thumb of how much income tax will be reduced when you apply that third entity, or does it vary depending on the types of benefits that are looking to be applied?
It does vary because the reduction comes in the amount of benefits that you pay yourself.
Right.
And, like, for example, you could set up your 401k plan as a retirement plan, and your business could you as a business owner can allow your employee to make contributions towards it, which would reduce their taxable income. And so they might want to, contribute 100% that's available. And this year it's like $20,500. So they could put in that amount during the course of the year, or they might say, well, I only want to put $500 a year in, or I want to put $1,000, a month, 500 a month, or $1,000 a month in. So it all depends upon how much
Got it.
in the way of benefits that they want to contribute. But we have run scenarios where we take a person, an artificial person making $100,000, and figure out what his taxes might be if he were to, just be a sole proprietor or a single member LLC. And then we've taken that same person and we put it in a scenario where that person was, running his LLC, but we're running his money through his limited partnership, reducing his self-employment tax, and the tax drop between those two are pretty good. And then we've run the third scenario where we have some employee-related benefits associated with it, where we're having them pay 100% of the 401k benefits, helping them pay themselves a health savings account, HSA account, which is a really great benefit, and having them pay for basically their family's health insurance out of the proceeds. And in that scenario, we've been able to reduce the taxes between that first category and the third category by just about 50%.
Mm. That's crazy.
So it can be a great tax savings by bringing these three entities together. Plus, like I say, the best liability protection you have available to yourself.
So Ross, as we wrap up here, let's assume that, an entrepreneur is listening right now and like, okay, I'm ready to take that next step. I'm ready to try and figure out, what is the right path for me in setting up the proper business structure, whether it's a 2-entity system, a 3-entity system. They give you a call, like, what's the first step? I mean, I'm assuming there's some sort of exploratory phase or a planning phase. Like, what happens when they make that decision? All right, let's get some protection in place while also reducing my taxes. How do you determine what the right structure is for them?
Well, once they decide to become one of our clients, we schedule a phone conversation between myself and the client. And I spend a good hour, sometimes as much as 2 hours on the phone with them, talking to them about their specific situation. And then we explore the options for them. And if it makes sense to just go with a 2-room structure, at this point in time, and with the idea that the third may come along when they start generating additional income, we'll discuss the pros and cons of that, whether it's good for them to bring all 3 in right now. We can then run these same numbers, for them, showing if they continue with the way they are, if they, have the two entity structure or a 3-entity structure, the tax savings in each one of these categories that would be available to them. So we try to help them understand right up front what it is that what they're doing and why they're doing it. And then, of course, we like to provide additional ongoing training, we have a members area where there's a lot of different materials talking about lots of different aspects of this that they can go into and then they can read. We have, as you can imagine, instead of working out of one entity, you're working out of 2 or 3 entities. We have accountants that are available to help them do their accounting with this new structure type. We have CPAs that understand, what it means to be working out of 3 entities that we can, refer them to, that will be able to handle their tax returns for them. So we try to give them as much upfront coaching and teaching as we can so that they feel comfortable in what they're doing. And then we give them this back-end support as well.
Awesome. Ross, this was incredible. This is my second time kind of going through this process with you, but it makes total sense to me why, if you've hit a certain level in your business, you've been in business for at least, I mean, obviously you want this done as early as possible, but I think if you've gained any sort of traction in your business, then this is a no-brainer. Meaning, you know, the longer that you put this off, the more risk that you have and the more taxes you're going to end up paying. And it might sound really complicated. It might sound like a lot of mumbo jumbo. My intent with this podcast was to hopefully help simplify it and just get people to understand when you layer it together, when you put the right process in place and you are able to put the right level layers in place to protect yourself while also taking advantages of the tax code that's in your favor, that's designed for you in an ethical and a legal manner, then you get the best of both worlds. For me, we run an S corp, so we're a single entity system. We're in an S corp because we wanted to do that for tax, tax saving advantages. But we don't have the protection of an LLC. And so selfishly, my questions were geared around that, like, okay, what should we do? What should our setup be? And now like we have a clear picture of like, all right, let's figure out how to put this together. And Ross, we're going to be having a conversation with how to do that. And if somebody's interested, where do they go? Ross, what's the URL? Do you have a website that people can go check check your stuff out, book a call with you? Where can we send people?
Yeah, we have a website. It's businessstructuringsecrets.com. And if they were to log in there, there are different places that they can go at that website that allows them to, schedule a call with our company, and just kind of helps walk them through. And once we've been able to talk with them on a call, if they decide they'd like to go forward with what we have to offer, and then they are scheduled with a phone appointment with me or a Zoom appointment with me where we can discuss their specific needs at that time. But businessstructuringsecrets.com is our website.
Awesome. So we'll link that down in the show notes, and there will be, links on this page somewhere else where, it'll be very clear where they can click and go to that URL. Ross, this has been fantastic. Thank you so much for, opening up your, the kimono and just unlocking your brain and seeing how your brain works. I think it's really, really important for entrepreneurs to understand we're all at risk. And I never knew that. 50% of small businesses got sued last year. That's freaking terrifying. Like,
Yes, it is.
somehow I've dodged that bullet, but I mean, 50%, that's a high rate. Like, that's a terrifying rate. Terrifying rate. So if that doesn't get you motivated, at least protect yourself. I don't know what will, aside from an actual lawsuit. But okay. Anyway, I digress. So we will include a link down below, and you'll be able to find where you can connect with Ross and connect with this team. Ross, thanks again, my man, and we'll talk soon.
Thank you very much. Appreciate your time today.